Most traders think that their profit or loss comes from just price movement alone, but there's a hidden cost that you need to know about, and sometimes a hidden profit that's quietly applied to your account every single night, whether you know about it or not. And it's called carry or rollover. And once you understand it, it completely changes how you think about holding trades, swing trading, and any long-term positioning in your trades. If your strategy looks profitable on paper when you've done your testing, but not in the real live account, then you need to watch this video right now. So in this video, I'm going to show you what positive and negative carry are, how traders accidentally bleed money without realizing it, which is really common, and how professional traders use carry as a tailwind instead of a tax, and how this can dramatically improve your long-term results as a trader. This is one of the most misunderstood and underused concepts in trading from what I've seen. So what is rollover? Well, let's start simple. Rollover is basically the interest you either earn or pay for holding a trade overnight. And it can be beneficial or it can be like a silent cancer. Every single currency has an interest rate attached to it. And because Forex is trading in pairs, every trade involves two interest rates, not one. So when you hold a position past the daily rollover, which is typically 5 p.m. in New York time, your broker applies the interest rate difference between those two currencies to your account. You don't opt into this. You're not aware of it. You don't turn it on as a feature in your platform. It happens automatically whether it benefits you or not. So when thinking about positive versus negative carry, here's the rule that you need to know. If you buy a currency with a higher interest rate and sell a currency with a lower interest rate, you earn what we call positive carry. And if you do the opposite, you pay it. That's negative carry. So let's use a simple example. If you go long the Aussie dollar, you're buying the Australian dollar and you're selling US dollars. Now, if Australia's interest rate is higher than the US, you earn the difference. If that difference is, say, 2.75% annually, then that interest is credited to your account as long as the trade remains open. Now, here's the most key point that traders miss, or most traders miss this. That interest is calculated on your full market exposure, not just your margin. So this is where things get really interesting. If you're trading with 100-to-1 leverage, every $1,000 or £1,000 of margin controls £100,000 in the market. Well, at 2.5% annual interest rate on £100,000 is £2,750 per year. That is a 275% return on your margin purely from holding the trade. And at a 50-to-1 leverage, that's still 137.5% per year on the margin used. So this is why large institutions and fund managers pay close attention to carry. When price aligns with interest, you're not fighting the market. You're letting time work for you. So at this point, you might say, well, but I'm a trader. 2.75% is nothing. And that's what most traders tell me at this point when I explain this concept to them. And normally what they say is, I'm here for like price moves, not a few percent a year. And that exact mindset is the reason why they miss the real opportunity. Carry is not about replacing your trading. It's about stacking advantages in your edge. Price movement, time, interest. If the market trends in your favor, you get capital gains plus carry. If the market goes sideways, you still get paid. And that fundamentally shifts your expectancy on your strategy. So now for the risks, because this is important. This isn't free money. Carry trades are not risk-free. To earn interest, the trade has to remain open, which means you're exposed to market movement. And what that means is stop losses are absolutely essential if you're not using one. You need to use one. Also, position sizing matters. And you have to also give the trade room to breathe. Because a carry trade stopped out early is a failed carry trade. The goal for this is longevity and not necessarily precision entries. So it's much more suited to swing trading. This is why I use weekly charts for carry opportunities, because weekly structure gives you long-term support and resistance, a clear context on the prevailing trend, fewer emotional decisions happen in the weekly chart. If price goes sideways for a year, you still collect rollover every single night, and that becomes your, time becomes your ally. And I remember one of the best carry trades I've taken was the Aussie CAD. And at the time, the trade offered about a 4% positive carry. And the setup aligned with a weekly trend reversal at structure. And I held that trade for nearly 2 years. And what that resulted in was about 6% account growth from interest, about 15.5% from capital gains, just shy of a 22% total return. And all the actual decision-making process and time that went into that was just a few minutes a week. Okay, so here's some rules for carry trading. If you're going to use carry properly, follow these rules. Rule 1 is trade only in the direction of positive carry, because a great setup that pays negative carry works against you over time. Rule 2 is place stops beyond long-term structure, not tight swing levels. And then rule 3 is risk absolutely no more than 3% per trade. Why? Well, these setups are rare. Time improves expectancy. Reward to risk is typically much higher than short-term trades. So you want to make sure that you're managing your risk wisely. So I think the big takeaway from this concept and this video is that most traders usually only focus on entries, but professional traders think in terms of refining their edge, structure, time, costs, hidden advantages. And carry is either one of those things where it's a silent drain on your account or a really quiet compounding edge. And the difference is whether you're aware of it and aligned with it or not. So if this opened your eyes, let me know in the comments. If you want me to give you a real example of a trade that I took in the markets and walk you through that, let me know in the comments. Just type in positive carry. And in the meantime, go and check out all of the other videos on this channel. And if you're really ready, and you're thinking, actually, this is much harder than I thought. I can see why traders need support of this stuff if they're because you're not going to find anyone talking about this sort of stuff online. You just see these kind of traders flexing their apps and all that. It's not real trading. They don't know about any of this stuff. And if you really want to learn and lean in on this stuff and get coached, check out tier1trading.com, where we have a full comprehensive coaching and mentorship program over 12 months. So till next time, see you in the next one.